Thank you so much, Rolly, for the nice welcome here. And thank you so much, guys, for sticking around. It is 8:30 Eastern time here. And I know that you have to take time to attend these events, take time from a wonderful, wonderful summer. Well, it's kind of cold, chilly. It's kind of chilly here in Detroit, Michigan. So for the Midwest, it's actually pretty cool to be inside and kind of like listen in on these presentations. And by the way, Robert had an amazing, amazing presentation before. Okay, so thank you so much, guys, for being here. Thank you so much, TradingPub, Rolly, and Yana. Thank you, guys. And I am here today to share with you the one strategy that made me very, very successful in trading. And this is actually one of the first strategies that I have applied in trading because it gave me more clarity. And once I started to become consistently profitable with the strategy, then I moved on and added more strategies along the way. So today's class will be fast tracking your trading with one simple strategy. Before we continue though, please take a minute to read our risk disclaimer. And basically what we're saying right here is that everything that we're going to talk about today is for educational purpose only. It should not be construed as investment advice. And if you want to seek financial advice, please consult your broker, your financial planner, your advisor. Okay, so a little bit about myself now. Thank you, Rolly, for the warm presentation. So for those of you that don't know me, I have been a professional independent trader focused on equities, futures, and currencies for the last 10 years. I have over 15,000 hours spent in front of the computer and trading full-time. I'm also the founder and CEO of TradeOutLoud.com, and if you should visit the website, it is a trading education website. We offer education products and services that are quite unique to some of the other firms out there that are actually providing education services. I have over a decade of investment banking experience, and this is prior to becoming an independent trader. I am certified from numerous financial institutions, and I do run a managed accounts program for a group of high net worth clients. I also run a very successful swing and position trading signal service for equities and ETFs. And like Rolly mentioned, I'm the designer of a trading system, the very simple, I might add, trading system, and I pride myself with that, of a system that is based on clear and clean price support and resistance areas, and these are multiple price support and resistance layers that exist in the market, correlated with trigger times, with charts and specific time frames, and along with a strict set of trading rules. I'm also a contributor to a lot of magazines, some of which I have right here. I have just mentioned right here. Also, Market Deal and TradingPub also publishes my Trade of the Weeks. For those of you that do follow the emails, you could probably see the trades that I post. They're complete trades with exact entries, stops, target areas, and charts. And I don't want to brag, but they were super successful. So we did have, if we have enough time by the end of the session, we will bring up some of the trades that, the last 2 or 3 trades that I've published with Market Deal. But if not, you can check marketdeal.com for the trades for full transparency. So why should you listen to me, and why should you choose Trade Out Loud for your trading education services or for trading education products? Well, because we offer a lot of education and coaching programs that are personal. Most of them, 90% of them, are offered by myself. I have a proven, public, third-party verified track record. And also I have excellent feedback from our worldwide traders. I trade with traders worldwide, and we are actually rated by a third party 5 stars out of 5. So we pride ourselves with that as well. And we have over 10 years of trading experience and 3 years of teaching experience. So this is new, something new that I've added to my portfolio, and this is because of high demand by my friends. This is how it started. So this is how I started teaching. Okay, because other than that, I love trading, so I would rather trade. Okay, so if you want to stay in touch with me, you can send me your your messages, your thoughts, your comments at info@tradeoutloud.com. You can also find me on Facebook, tradeoutloud.com, and also you find a lot of trading ideas and updates on that Facebook and also on the Twitter page as well. All right, so without further ado, let me present to you tonight's agenda. So tonight, I will reveal the winning strategy, and I'm so excited for that. And it's going to come with a full package. I'm going to present the definition, the trade criteria, and the complete trading plan, what to look for in that specific trade, in that specific setup, and within market conditions to have a very successful trade. And of course, what is a strategy without a proper risk and reward ratio that you can apply towards it? And of course, the position sizing that is also very important and in strict correlation with the risk and reward that you're going to apply. So this is revealing time. Today, we're going to be talking about breakouts and breakdown trades. Very powerful. Some of you may know these strategies under different names, such as range breakouts or range breakdowns or consolidation breakouts or consolidation breakdowns. Basically, it all means the same thing. Okay, so why this strategy? Why did I choose this strategy, and why did I start with this strategy? Well, first of all, it is super simple. Super simple, especially for beginner traders, for traders that don't have a lot of experience in finding setups. Also, it works great for day traders, for swing traders, and investors. It works amazingly well with stocks, ETFs, and futures. And I have to add here, it works amazingly well with Forex as well. Also, it is easy to identify, and that's why I like it, because with an untrained eye, you can identify these setups. It is easy to understand. There's nothing complicated about it. It has clear defined entry areas, stop areas, and projected target areas. This is what I love about it. And it has a really good odds of following through if you follow the proper trade management. We're going to talk about this later on. And again, it's easy to apply. And also, it's easy to trade. So I'm very excited to dig deep right into this strategy. So breakout and breakdown. Well, first of all, let's take a look at the definition. It is the price action movement through an identified area of consolidation. So a defined area of support resistance. So any price that will break above the area of resistance, meaning the ceiling. So these setups, if you will, they are condensated in, bracketed, if you will, within really defined areas. And these areas are support and resistance. Support acting as a floor and resistance acting as a ceiling. Therefore, when a stock, when an ETF, when an A-mini reaches the resistance area and it forces through that resistance area, consolidates through that resistance area, and on heavy volume, we're going to talk about this and then we're going to visit some charts, it's most likely to break out of this range. So it's going to break this ceiling and go higher. The same thing happens with the weak stock, weak ETF, weak E-mini. When it travels to support, when it consolidates at that support level, it becomes weak. And that is a sign, that is the first sign that the asset is not going to continue higher, but yet it's trying to push lower. And when it breaks down, it breaks that ceiling, it will have follow through and travel lower if certain parameters are met. So price breakout or breakdown is usually followed by heavy volume and increased volatility. The breakout trades are the starting point of future volatility increase and large price swings. Now, whether you're a day trader, whether you're scalper or a trend trader or a gap trader, sometimes you see these consolidations happen on any time frame, even in gaps. When a stock, let's say, gaps up on earnings or not, or some news and rumors, you're going to see that some of them will consolidate at that area, meaning it will digest that area and seeking if there are going to be buyers above that resistance or there are going to be sellers below that support. And the more on a very strong stock, the more that gap up base, that gap up consolidation area, range area, the more it's going to stay there and the more it's going to, I would say, consolidate there for a longer period of time, more odds are into its favor of breaking out and traveling higher. So therefore, you can watch for these types of patterns on any time frame. Like I said, for a scalper, you can have these consolidation happen on the 1 minute chart or the 2 minute chart. For the gap trader as well on the 1 or the 2 minute chart. For the trend trader, for those of you that are following the trade, for those of you that like to trade larger time frames, after the trend has established, after 10 a.m. reversal time, mostly when the first setup is forming around 10:20, 10:30, that's the major trigger time in the market for trend traders, for intraday traders. So around that time, with the trend confirmed, it is established at that time, if you're going to get a breakout at that time, that is and followed by a lot of volatility, by a lot of volume, liquidity, then you're going to see a really great follow through for that particular trade. But there's one catch here. Remember, I will repeat this throughout the session. You have to go when you're looking for breakouts, you have to establish the trend. You have to make sure that this breakout is this consolidation area is occurring into an ongoing strong trend and you're not taking it against it. Okay, so don't take the breakdown on a very, very strong stock. Okay, that can be a shakeout, that can be a pullback after the base breakdown, consolidate again and travel back higher. So there are some things that you need to consider here. So the basic concept behind this whole consolidation phase into a stock, into an ETF, into an E-mini is that markets move from periods of high directional activity and volatility to periods of rest. Okay, so they power up, let's say they're ascending, and then once they reach either a resistance area or a projected target area, they need some time to digest their area. And if that asset is strong, it will consolidate at that price range before continuing higher. So it needs to take that pause. It needs to take that breather. It can't run consistently higher and higher and higher. It needs time to rest a little bit before continuing higher. This cycle repeats itself in almost every active volatile market. So you're going to encounter this everywhere. The consolidation breakout strategy seeks to enter the market at the inflection point where a market is moving from a consolidation phase to a trend phase. Now, what do I mean by that? And I have a little example here of a base breakout, breakdown, the way it looks on the chart and what you need to look for exactly. Now, before we continue, you have to understand that there are 4 major phases into a market. There's the consolidation phase that you see right here. So let's say a stock is very strong and it's traveling from way down here. It's moving from a swing low to a swing high, and then it's doing a pullback. Okay, so it tested an area of resistance, assumingly, and it's pulling back and it's consolidating, meaning it's digesting that area before it takes the next step, before it takes the next decision, whether it's going to continue higher or pull back even more. So at this phase, this is the first phase. This is stage 1. This is the consolidation phase. This is the tentativeness. This is waiting, and it's bouncing. Remember that association from, swinging from the ceiling to the floor and back to the ceiling, back to the floor. Okay, so it's just wiggling around from low to high and high to low. And sometimes these ranges can be a little bit with peekaboo highs or peekaboo lows, so they break a little bit just to test the waters to see, oh, am I going to get followed through higher? Am I going to get followed through lower? So they're just quickly testing, because you're going to see these topping tails or bottoming tails, and don't be fooled by them. So just wait and see how the pattern evolves and then take the trade. So this is the first stage. After this first stage, here's the breakout, guys. So here's the entry right here, and this is the accumulation phase where all the traders want to be part of, whether it is zigzagging right here or whether it is a straight leg up into the next resistance area, let's say allegedly on a strong stock, okay, and you're reaching again, the market needs a breather, whether it is prior high right here, whether it is the resistance and it reached a target area, but again, whatever the case may be, or a projected target or a fib projection, in case, you know, the stock or ETF or A-mini has reached an all-time high, you need to use these projections, right? So again, stage 3 right here, consolidation phase. You can see that stage 1 and stage 3 is exactly the same, This is the waiting period, the decision period as well, after which distribution follows. So in case, you know, geopolitical context or some news or what have you, you know, you get a breakdown right here, it can revisit the prior low and it can take another consolidation. But guess what? This can even go the other way around, meaning from stage 1, it can enter a stage 2 with an accumulation phase, a stage 3 again with a consolidation. And remember, guys, an object in motion tends to stay in motion. So therefore, a very strong stock, once it's consolidating here, it moves ascendingly to another consolidation phase, and from here on, being a strong asset, it will travel higher, meaning it will have odds of continuing higher after this consolidation phase. Same thing the other way around. On a weak stock, on a weak asset, you get a consolidation phase, then it falls, it breaks down, and it falls lower, then you have another consolidation phase, and at this point, it can actually travel lower. Okay, and this was just a quick example. And just so you know, these breakout trades or breakdown trades occur only in stage 1 or 3. Okay, so breakout trades or breakdown trades occur only in stage 1 or phase 1 and 3. Okay, here are some conclusions to our strategy here. A breakout is a stocks or a mini's price action that moves outside of a well-contained area, well-defined area of support and resistance on increased volume, because you're going to get a lot of follow through. There are a lot of traders that are following this strategy. And just institutional traders, high frequency trading machines that are their algorithms are configured based on these types of strategies. Okay, so that's why you have a lot of odds of following through and having a lot of odds of your trade following through to your next target. A breakout trader enters a long position only after the stock or ETF or E-mini breaks above resistance. Look at this example right here. This is a stock. Same example applies for ETFs, for E-minis. I'm going to show you some other examples as well here. So you could see, and the consolidation was rather sloppy at this point. So in an ongoing trend, you have no reason to short setups like these that are running into resistance, okay? Because the life is going to be very short, okay? Very, very, very short life. And then again, you have the opportunity to buy low and sell high, or keep it and place your stop right here. And at this breakout area, you are going to continue higher. So this is the breakout point right here, and this is resistance, this is support, and it's defined. So please note the definition here. Okay, and this is for a long, long period of time, and this is actually an example of a trade that has been consolidating since mid-August until mid-November, so for a period of months right here. Okay, so if you're a swing trader, if you're a position trader, these are the strategies that you're looking for. These are going to be strategies that are easy to identify because of the very defined area of support, very defined area of resistance. You can even place limit orders above these areas right here, okay? You can place stops so you can have the trade on autopilot, okay? Now, a breakdown trader will enter a short position after the stock ETF or E-mini price breaks below support. Now, this is a strong case. So you're not going to take a breakdown here because of the strong asset, but you're going to take a breakdown only on a very weak trade. Okay, on a very weak pattern. So remember the phases. This is the accumulation phase. At this point right here, we were in a consolidation phase and a decision phase, and we continue at phase 1, which was around here. We continue with the accumulation phase, and this is phase 2. And here, a large phase, and for a very long period of time, a very large phase 3 again, another consolidation, another tentativeness area, another decision area from which we were traveling higher. Remember the example, and remember what I said, that an object in motion tends to remain in motion. So here's the example right here. Okay, so I have made it, I think, quite easy. And I try to divide this whole strategy into 7 steps, into 7 considerations, and some exceptions to the rule. And here's the next step of the strategy. So basically, there are 7 major steps to the strategy that you have to follow. Well, the first step is to have a well-defined method of finding trades that meet your strategy. So you have to be prepared when you're going to start, and you're going to start, say, and when you're, let's say, you can, and actually you can apply and you can look for the strategy. For those of you that are Forex traders, you could actually look for strategies as soon as tonight, and actually I did identify the pound dollar consolidating on the 1-hour chart. So have the strategy well defined, and make sure that if you're a day trader, you're going to look at minor time frames. If you're a swing trader or a position trader, you're going to look at major time frames. And what I mean by that, you're going to look on the daily chart, weekly chart, monthly chart. Also, scan for these ranges, for these consolidations, for these breakouts in ongoing trends. I like to use a real-time stock scanner. I do use Trade Ideas. I have been using it for, oh my gosh, I don't even know, maybe 7, 8 years, 9 years, somewhere around there. It is a very good scanner. If you take it through my website, you get a big discount. So you could visit my page under partners. You could actually test drive it for 2 weeks, see if you like it. Or there's another real-time scanner, guys, out there, and it is called MadScan. It is free. And you can also use that for your strategy, for your consolidation, for your base strategy, for your range strategy, to find these strategies for you, to make it easy for you, especially if you're a day trader and wanna start using the strategy. Or you can use websites. You can use FinViz, and you can customize to find a lot of trades like this. Or you can use bar chart as well, and go under stock tab, and you can look for ranges. And especially if you're a swing trader or a position trader, that's going to help you a lot. Also, identify market conditions and trend. And here it is imperative to look at the market conditions. You're not, even with a strong stock, if you identify a strong stock, a consolidation that is ready to burst, ready to propel higher, to break that resistance and travel higher, you got to look and read the market conditions, because if the market is into a sell point, if it reached any kind of resistance, if it reached some kind of geopolitical context and is pulling back on for that reason, you're not going to take that breakout because it has less odds of succeeding. You have to have the market on your side. So let's say if you're trading Adobe, if you have or Microsoft or Yahoo, and if you're identifying a range in those particular stocks, but if the Qs, for instance, are doing a sell and are kindly trying to roll lower, you're not going to take that breakout. You're just going to watch it. And most probably what it can do for you, fool you, get you in, trigger, and then travel a little bit, you know, just enough to get you in, and then it's going to go back and take you out of the trade. Also, identify the consolidation area. Make sure that you identify the strict area, support, resistance. Make it super easy, super clean. Use the drawing tools on your charts, whatever charting you're using. I'm sure most of the brokers have a lot of tools that you can use. Mark them. They're clear for you, and especially if you're a position trader, mark them, because once you're going to type in that stock, once you're going to revisit it, you have it on your list, you have it on your watch list, and once you're going to click on it, that is going to highlight the trade for you. It's going to be there. It's going to travel in time with you. So it's really great to have that reminder on the chart. So super simple to have it as well. Also, set alerts, set alarms once it reaches those areas. So let's say, for instance, you're in a strong stock or A-mini in an ongoing trend, and you know you have that A-mini that is ranging. Set an alert for a price where the price should trigger, and that, if you're a day trader, that's going to draw attention to you, and then you're going to you quickly move to that chart, and then you can take the trade and, you know, just kind of like take the decision right there. Also, define exact consolidation-based parameters to determine support, resistance, and projected targets. So important. So once you identify your parameters, like your entry should be above resistance, your stop should be below support in an ongoing trend, uptrend. Also, make sure that you have your projected targets calculated, whether it is a previous high or whether you're using Fibonacci projections, what institutional traders are using, especially for stocks that are at all-time highs. I have an example here with you to see how to get your feet wet for those of you that are not using it, to see how awesome it is to use it, and it gives you an edge, and it gives you a winning edge on that trade, something that other traders don't have. Also, step number six, determine the exact buy-sell area and stop. Very important as well, like we've mentioned. And also 7, the last one, from this point forward, your trade should be on autopilot. So that's what I like. My personal preference is to trade a little bit larger time frame. So that meaning when I'm day trading, whether I'm day trading in minis or stocks or ETFs, I like to live off the 5-minute chart and the 15-minute chart. That's my zip code. And when I'm swing trading, I use the hourly chart, 30-minute chart, and the daily chart. So that's what I love to trade. So I have a better definition of price confirmation at that point. They're not so wiggly, and support areas at these time frames that I've just mentioned are stronger than other support areas, of course, on minor time frames such as the 1-minute, 2-minute, and so on. And for those of you that use the 3-minute as well. Now, here are 7 rules to consider, and guys, you shall, you will, and you must obey these rules, these considerations. Okay, so breakout trades will be considered only in an ongoing trend. Like I've mentioned at the beginning of the session, there are things that I'm going to keep on repeating because repetition is the key here. So remember, you have a very strong stock, you're going to look for periods of consolidation, you're going to look for periods of pullbacks and consolidations in order to take them higher. So you're going to look for these areas to continue higher, or you're going to look for very weak stocks that have fallen, consolidated, and then you want them to continue lower. Number two, the consolidation area, the base, the range should be defined by clear support resistance, like I've mentioned before. Remember, sometimes they're sloppy, but sometimes they're very, very clear. Sometimes they're like mini patterns, zigzags within that range, like you saw on that chart, that example. And sometimes there are bars, you know, like a Christmas tree effect, one red, one green, one red, one green, and pretty much the same size. I'm going to show you some example. And one example is the market, the Qs that did that last week, the whole consolidation last week. And actually I do have a trade in the Qs right now. Since Sunday night, I placed my limit order, and it's actually going really, really well. So I'm going to share that with you. Also, it is advisable and recommended to wait for price confirmation. Very important, guys. Meaning, wait for the price of the asset to prove itself. So therefore, to trigger and break that resistance area at the trigger point for long positions and support for short positions. What I mean by here is that never get in on an asset before the trigger. Because you need the price to confirm that it can actually type in, that it can actually reach, that it can actually break out that resistance price line. Okay, no cheating here. Okay, you might say, yeah, but you know what, if I take it here, you know, somewhere in the middle, you know, maybe it's gonna work. No, it might work. It might work. You might be lucky and it might work. But in most of the cases, it's not going to work for you. So wait for those trigger times. Never cheat on your entry. Never get it before the trigger, ever. Okay, this is my rule number one, by the way. Okay, the entry should be considered only above resistance for long positions. And remember, if you're a day trader or a swing trader, you're going to look for a few pennies above that area, depending on the size of your stock. So if you have like a stock like, I don't know, very, very small stock, I don't know, like Ford or Nokia or something that has a small price range, is into a small price range, then you're going to look for a penny or two. If you're in a stock, let's say like Apple, where it has kind of like that wiggle, you can take it 5 or 6 cents above that range. Okay, so make sure that it triggers and it proves to you that it can travel beyond that resistance point. Stops will usually be placed under support for long positions and above resistance for short position, and the same rule goes here. Same rule goes here, meaning that you need to you really need to wait. You really need to give it that wiggle room. Remember, resistance and support are areas. They're not strict. They're not strict prices. Okay, it's not 57.31. That is resistance. No, that is the resistance area, and from that area it can wiggle a couple of cents, a few cents. Okay. Okay, so the next thing is that targets will be set into prior resistance or support areas. Okay, so we're going to talk about targets. I have here an example for you to show what resistance and what support can do for your asset. Also, once the trade triggers, it will be trailed according to each trader's trailing system. So you have to have a very good management system before you even continue to move higher. Whether it is, if you're a very, very beginner trader, you can actually apply the candlestick trailing method, which is trailing based on candlesticks, or if my preferred method of trailing, and I'm very good at it, And for those of you guys that are in my program know how I hold on to a stock, and I'm right for holding on to a stock but sometimes, you know, you're wrong, and you know, the trade can take you out. But remember, I never get out of the trade because I'm bored. I never get out of the trade because you know, I've reached my target and I'm done. No, I let the market take me out. I have a strict trailing system in place, a unique trailing system that I apply to each asset. It is the same system. I apply the same system. My preferred method of trailing is by pivots. So once it travels higher, let's say it breaks out, it travels higher, I patiently wait for the pullback to form. I patiently wait for the next support area to form. I wait patiently for the asset to continue higher, and after it breaks the previous high, that's the area where I'm moving my stop. So that is called pivot trailing. You can also trail. There are different methods of trailing. You can also trail according to moving averages. If you prefer moving averages and an ongoing super strong trend, you can trend, especially for day traders, you can trail based on the 10 exponential moving average. This is a more aggressive moving average that is following price more aggressively on minor time frames, or you can choose usually pullbacks, kind of like a curl around the 20 period, a 20 simple moving average. That is the 10 exponential moving average that I talked about. This is the 20 simple moving average that I'm referring to right here. So regardless of your trailing method, you should have this in place. You should feel comfortable with it before you even initiate the trade. So remember, step number 1, identify the area, identify the trade. Step number 2, place your limit order or alert at the trigger. Place your stop below support area, and this is in an uptrend, in a stock that is uptrending or asset that is uptrending. And make sure that before you even consider placing that limit order, you already have your target areas aligned, okay? Because this is very important. We're going to talk about at the end of this class a little bit of reward and risk and position sizing. Okay. These are the seven indicators that I use, and I use these for my stock trading and my ETF trading and my E-mini trading, not for Forex. So this is the 20 simple moving average, 10 exponential moving average, and especially for those of you that are day traders, I highly recommend this. These are elements that work for me. These are indicators that work for me. I also use the 200 simple moving average, the 50 period moving average, and this I recommend only for major time frames, meaning weekly and monthly time frames. Same with the 89 simple moving average. Also, these are good for swing and position traders. And these two are areas, the 50 and the 89 are areas where a lot of traders are looking to initiate positions once trades. And this is for mostly for position traders. But these are areas where a lot of traders are looking to initiate new positions off. So I pay very close attention to those two. I also use daily pivot points, and I'm going to show you some the charts that I use and how they're configured. So these intraday pivot points give me a lot of clarity into a different level of support resistance that brings more to the table than just support resistance formed by natural price action of the asset. And of course, I use volume. I want to see those institutional traders' footprints. So that's where I'm going to see them, on the volume, on increased volume, on a spike of volume. That spike of volume, I'm also going to follow it throughout the life of the trade, because on a very high spike of volume into my target area, and especially into the final target areas, might suggest that the price movement is approaching an end. Okay, so therefore it is an alert for me to zoom in to a closer time frame and to tighten my trailing system. Okay, with all the strategy, there is an exception to the rule. All right, this is very aggressive. I highly recommend you do not use this until you are fully successful with the conservative approach. And this one that we have talked about was the conservative approach to trading a breakout, to trading a consolidation breakout or breakdown. But there is this aggressive advantage to this breakout or breakdown strategy. So in a very strong ongoing uptrend or downtrend, okay, you could look at the other face of the coin, traders can initiate a buy action at the bottom of the base, in the proximity of the bottom of the base. But it has to be above that support area, okay? So not below. It has to be above that, in that wiggle area. So you buy it as close as possible to that support area and place your stop below the support area. So this, yeah, and again, this is cheating, all right? This is a little cheating. But again, you have to know what you're doing. And after you have been trading bases for a while, you're going to feel comfortable probably initiating some trades like this. So basically, you're buying above support, but placing your stop below support, okay? So you're cheating a little bit. At the same time, when you're initiating these types of positions, and I'm going to show you on charts, I always get in with half of my position. I don't risk the entire amount. So let's say if I'm risking $200 per trade, I will position size for $100. So I'm taking half of my position here. If the trade is moving higher towards my conservative entry area and triggers, so I wait for the trigger this time, I'm adding the other half a shares in. So I'm adding my other $100 because in each trade, I'm risking $200. The stop remains the same. On the second half of the position, the stop remains the same as for the first half of the position below the support area. And now you can see that my trade, by the time it reached resistance, I'm already in the money. I already banked some money. I'm already in the green. And when the second half triggers, I am getting full position and it's ready to continue higher. And then you apply the traditional trailing strategy of your choice. Okay. This method can be applied, like I said, to stocks, to ETFs, to E-minis that have been consolidating in the area for a relative long period of time, demonstrating strength. It's all about strength, and this is for a breakout. And for a breakdown, it has to prove to you that it is demonstrating weakness, and therefore that's when you're going to look to short right below the resistance area with a protective stop above the resistance area. So that's cheating a little bit. And then you're going to add the other half of shares below that resistance, area. Okay. All right. Here are 7 considerations, and then we're going to move to charts, and that's the fun part. That's the visual part. Okay. This is the theoretical part. Okay. So number 1. For swing traders, there are some rules here. So usually stocks are consolidating before earnings, before they report earnings. Don't be fooled. Don't be fooled by these ranges, and especially I'm addressing for those of you swing traders. If you're a day trader, you're in and out the same day. But if you're not, if you're a swing trader, it is advisable, and I highly, I live by this rule and never get into a trade. I never get into a swing trade before it reports earnings, okay? Because I don't want to have any surprises. I don't want to wake up and see that I'm down $5, or I'm, I may be lucky and I may be up $5, in a trade, or 7 hours or 20 hours or what have you. But it can happen the other way, so it can kill you. It can kill you. It can put your account into red, okay? That's not good. So for those of you that are swing traders in here, try to never take these breakouts ahead of earnings reports, okay? So if a stock has earnings at the end of the day, you're not going to take that breakout. Even if it breaks out, you're not going to take it. Even if it has that picture perfect uptrend with a consolidation and a breakout, you're not going to take it because earnings are due and you don't know what the reports are going to say. You don't know what's going to happen. Same thing if the stock will report earnings the next day. Pre-market, you're not going to take it a day ahead, okay? So do not take it. Take it after, okay? Take it after. Let's say if it gaps up, consolidates, all right, take it then. for a day trade or a swing trade, depending on the case. Also, have a defined entry area. Remember, with the trigger, never, kind of like never cheat. Okay, never cheat. Wait for that price entry. Have a very defined stop, and this is knowing your resistance or support area. Have your projected targets and management in place before you even consider taking the trade. Also, look for very liquid assets, and what I mean by that is look for stocks that are highly traded. I never day trade or swing trade or position trade stocks that are trading 50,000 shares a day, that are trading 25,000 shares a day, that are even trading 400,000 shares a day. No, I look for highly liquid stocks of at least 1, 2, 3 million shares traded a day, or 25 million shares a day. Okay, so I look for high volatility stocks. Why is that? It's because I don't have any slippage, I don't have any spreads. Okay, I love my high volume stocks, and this is what I'm looking for. Also, you must always trade in sync with the major time frames and with the market. This is the strict correlation. This is the one correlation that you need to respect. So if you're trading, I don't know, Microsoft or Yahoo, pay attention to what the Qs are doing. Pay attention to what the SPYs are doing. Okay. Now, and now if you've noticed, today, yesterday, the Qs are super strong. NQ is super strong. Okay. Stronger than the other market indices. Okay. So focus more on the market indices. So if the Qs are stronger than the other major indices like the Dow or the SPYs or the diamonds, what have you, okay? Focus on Qs and, NASDAQ stocks, okay? Because these are more likely going to push higher, okay? And they're going to travel higher. So one of the reasons why you're going to choose stocks that are stronger in a strong market is because they have higher odds of following through faster than weak stocks. Okay, then choosing a weak stock in a very strong market, and it will run ahead of the market indice. A strong stock will run ahead of the market indice. So that's why it is super, super important to stick to very, very strong stocks. And the same thing with weak stocks. In a weak market, you're going to look for weak stocks. So that's why you have to have a dual game plan. You have to have your weak stocks and you have to have your strong stocks. And depending on how the market opens that day or the trend of the week is, you're going to focus on one or the other. If you have a super strong market, you're going to go ahead with your strong stock list or ETFs. And if you're in a weak market environment, you are going to go with your weak stocks, because those weak stocks have higher odds of following through and have higher odds of reaching lower targets faster than the market itself. Okay. Number 5, let the winners ride gradually, layering off shares or contracts as the trade reaches targets and becomes more and more profitable. Now, I truly suggest this for a lot of you that are swing traders in the beginning stages or day traders in the beginner stages. And why is that? Because it creates you some kind of comfort knowing that you already took profit on that trade. Also, target ones, whether you're a day trader or a swing trader or a position trader, target one is also the easiest target to obtain. You get the volatility, you get the spike, you get the volume. If you're in a swing trade and take it on the 30-minute chart or the 1-hour chart, you get the participation of those intraday traders that are pushing the stock higher. So that's why it's super important to layer off a little bit at target one. I usually advise my beginner traders as a day trading or swing trading rule to always take off half the position at target one. And also, for the rest of the 2 targets that I have on hand, target 2 and target 3, layer quarter off at target 2 and then trail relax the last target until it kind of like dies on its own. until you zoom in so many time frames that you're reaching, that you're basically looking at a swing trade and you're reaching the 2-minute time frame to trail out. You just want out of the trade, so you're tightening up your trail. You're not taking yourself out of the trade. You're waiting for the market, you're waiting for the stock, you're waiting for the ETF, you're waiting for the E-mini to take you out of the trade. Also, use protective stops to exit losing trades. And don't add to those loser trades, especially those of you guys that are day traders and even swing traders. Okay, not unless you know what you're doing. Okay, but it's better to use stops, protective stops, whether it is a soft stop or a hard stop. But make sure you have a stop and you have position size for that particular stop area. Always monitor the market indices. Like I've mentioned, it is very important to keep them in loop. And also, when you're looking at your trading platform, make sure you have a chart of the Qs, the SPYs, diamonds, Dow. I like to look at Dow. I like to use SPX. I like S&P 500. I like to look at everything. Pre-market, I always look at my E-minis because I'm an E-mini indice trader as well, futures indice trader as well. I love to watch pre-market activity. I love to watch the pre-market support resistance areas. Okay, they give me an edge of what's to come and how the market is likely going to open. Okay, chart guys. Okay, now to the fun part. Okay, here are some examples. These are examples of trades that I actually done, and you can find them in my portfolio. And by the way, when I said that I have a proven track record, I do have, since the inception of the swing trading service, I do have a track record of all the trades that I've done, the good, the bad, the ugly. They're actually not ugly, okay? So, but all the trades that didn't work, the trades that worked, everything. If you want, you can shoot me an email. You can see my email right here. It's info@tradeallow.com, and I'll give you access to my trading record, okay? And this goes back to 2011. Okay, RAD, here's a trade that I took November 25th last year. RAD was a base breakout at this point. We had a beautiful follow through to over $6 or $7 right here, or $7.50, and we had a defined support area, as you can see. So it bounced, so it from swing low created a ceiling area of resistance right here, and this is the point where it created that support, and this is where I started to watch it. It was in an ongoing trend. You could see the rising bottoms and the rising tops right here, so confirmation that we are in a strong uptrend. This is the daily chart, and a consolidation area here would actually prove that it would be ready to continue higher at this point if a breakout should occur at 545, and this is the area. So here's the trade long over 545. The stop is under $5. You could see the whole number, guys, right here, psychological number, also a fulcrum number. Very important areas of support resistance right here, psychological areas. A lot of traders use that. Here is the 50-period moving average, guys. Remember when I've mentioned the 50-period moving average? This is the area where a lot of institutional traders are looking to initiate positions on. Here's the first target. It was at $6 based on a projection, $6.45, $7, and $7.50. You can see the breakout right here. This is the entry bar. This is a daily chart. This can very well be a 1-minute chart. This can very well be a 5 or 15 or an hourly chart. You can find these patterns anywhere. The pink moving average is the 10 exponential moving average, and the blue one is the 20 simple moving average. So you can see it right here. Now, remember the exception to the rule, okay? So the exception to the rule, meaning what you do is you buy the setup that occurs right here, right above support. Place your stop below the support area right here. Remember, give a little bit of wiggle room, especially if you're swing trading or position trading. Give it a little bit of wiggle room. Remember, support, resistance are not exact prices. They are areas. Okay, so once you initiate the trade right here, you sit in the trade, okay, and this is your cheating opportunity right here on a daily buy with the possibility of follow through into the previous high right here at 550. You have a very good risk to reward ratio by the time it reaches the prior high, the prior resistance that was formed right here. And then again, you know, it's pulls back, you're calm, you have your stop below the support area, and then it travels back higher. It neglects to break out. So here you are with your half the shares in. It's traveling higher, pulling back right here, testing support area for the third time, or rather for the fourth time or fifth time right here into this area. And again, it's just traveling quietly, and then the last pullback before the breakout. And guys, right here, I'm getting in with my other half of position. This is my cheating point, but it's not actually cheating because this is an ongoing trend, and this could have very well went to the prior high and continue higher. But right here, so I'm in here, let's say with 100 shares, I'm adding here the other 100 shares if that was my position size. And continuing higher, and it actually did reach all the targets. Okay. The next one, oops, sorry. The next one, also an example, and this is on a monthly chart. I just want to show you that these setups can happen at any time frame. So the more they happen on these larger time frames, these consolidations, the stronger they are, and they kind of like put their fingerprint on the smaller time frame. They influence the smaller time frame. They transfer their powers to the smaller time frames, to the minor time frames. So you can see right here defined, we have resistance support. So remember, this is the first thing that we need to identify, along with the trend, very strong trend. Again, very strong area of resistance, and the breakout bar right here, $66.41 straight. What's trading at this point? So at this point right here, right above this resistance, this would have been your entry, this would have been your stop under the support area if you're a core trader. Okay, eBay right here, this is another weekly chart, and you can see the strong consolidation right here from swing low to high. Again, revisit of the floor and the ceiling, the floor and the ceiling, the floor right here before the breakdown. Okay, this is the breakdown area right here. This is the test, the breakdown area. But again, guys, why did I put this chart in here? This is a no-no. This is a no-no trade. Why? Well, first of all, because it is a very, very strong trend, and this, you're not going to take this short right here, okay? This was a little trick. Okay, so Qs right here, this is a daily chart. By the time they were at it, trading between 83 and about $81. So here we have defined support, defined resistance. You can see the grind up, small candles, one big down, one big candle down, retesting prior support. And also this was a gap up support because this is a daily chart. It was a gap up support right here, and strong, continuing higher. You could see that on the day trading level right here, these two candles right here, very small parameters, have been basing. So for 2 days, another mini base within this large consolidation right here with a breakout, a very, very large breakout. So on the third day right here, after these 2 days of consolidation, intraday traders, bread and butter setup for them, moving higher. And again, breakout right here, my stop is still here. Pull back and continuing higher, back 84, 83, and continuing higher. Proof today is that it's trading $97, 96, okay? Another example right here, Apple, consolidation at this point right here. You can see expecting a breakout, so have patience, wait for these setups to happen. So this is expecting a breakout right here. Also, Yahoo, again, consolidating strong. This is a 1 hour chart. You can see the clear defined area of support and resistance right here. And possible breakout occurring $36.74. Also, Yahoo, this is actually, I took this snapshot yesterday. This is the 15-minute chart. You can see it right here, consolidating strong, defined area of support, defined area of resistance, okay? And because we talked of the Qs, I want to bring my chart real, this is today's chart. This is a 1 hour chart of the Qs, but what I want to bring up right here, okay? Anytime my chart is ready. Okay, here it is. Daily. All right, look at this area. This happened no longer than last week. You can see the strong consolidation, 1, 2, 3, 4, 5, 6 days of consolidation right here forming a lower resistance area compared to this prior high right here. So we had a resistance area at $95 and we had 93.85 as support area. I trade these setups almost every day. I find these setups every day and every week, and I love to play them. This is actually a trade that I initiated on Sunday night. I sent it to all my traders, over $95. So this was our entry, $95. The stop was under $93.85. And look at it today, $96. Actually, it did, the high today was $96.95. It closed at $96.93. And I have a final target on it of $97.51. And I do have some projected targets into 98 and further for a swing trade. But beautiful so far, beautiful risk to reward so far, moving higher. And look, 1, 2, 3, 4, 4 days of 4 days of strong breakout continuation. Same here, Yahoo, and let's take a look at Yahoo. Okay. At a live chart of Yahoo. Okay, here we go. This is the daily chart right here. Look at the strong consolidation. Look at the strong consolidation. Basically over $37. This is a confirmation for Yahoo for continuing higher. For those of you that are day traders, I'm going to show you a beautiful setup that is occurring right now, and this is happening now, today. Okay, beautiful breakout happening right now. Watch Yahoo for tomorrow if we're going to get a strong market with a push higher. Watch Yahoo over $36.45 with a continuation higher into $37 for the day. So for tomorrow. So tomorrow, Friday, look for a continuation higher. Usually Fridays, summertime Fridays are not as strong. A lot of traders take a lot of time off. And take Fridays off, but nevertheless, look for a strong consolidation breakout right here over $36.45 in Yahoo. But okay, so you get the idea of how it works. Also, Intel. This is a trade that I've done. You could see it this year, early this year. The consolidated since early February till almost till mid March. You can see the strong consolidation right here. I actually had a presentation and I was presenting. It happened, the presentation was actually at the beginning of March, and I was watching this congestion area right here, and I was hunting. I was zooming in for a breakout opportunity for Intel. This is support, this is a resistance, this is the entry bar right here. Look where it is trading right now, $34.10. Of course, this is the entry area. My target was in this area right here at $27. You want to know why? Oops. Sorry. Okay, gotta look for my chart. Sorry, guys. Okay. Sorry for that, guys. Okay, here it is, Intel. All right, here it is. Here's the base. Here's my entry. Here's my stop. You can see it right here. Target one was at $27. And why is that? It is because I have a prior high right here. So you can see how by knowing prior high resistance areas, you can project these. And at this point, it was at all-time high. So how did I know that it's going to travel higher? And why did I stay in a core position initiated here? I have to admit, I had half the stop right here because I was seeing the projected targets. I had a half stop right here and half stop under this pivot. Here they are, my beautiful projections. And see how they move? Look at this consolidation right here. Okay, moving higher into 100% retracement. And then look at my beautiful projections right here. Okay, these are Fibonacci projections that are beyond, that are calculations beyond 100%. Okay, so sorry for that. I gotta go back. Sorry, guys. Okay. Okay, now, this is the complete trading plan, and this is actually super simple. When to take the trade? Any time of the day. Just wait for the pattern to happen. It is very helpful to set alerts or limit orders. Remember, in earnings season, there are a lot of opportunities on heavy volume and you get a lot of follow through. And for swing traders, guys, don't get in ahead of earnings reports. That can be a killer. And for day traders, entry after the trend has established over 10 a.m. are highly, highly successful. And remember, look for stage 1 and stage 3 in an ongoing trend, and look for those consolidations off minor support and minor resistance areas, and correlate the time frames. Also, how to enter the trade? Enter at 1 or 3 cents above the range or below the range, depending on your trade, whether it is long or short. Set your targets, use your projections, use all your trading tools in order to know that, especially if the stock, a lot of stocks are right now at an all-time high. Position size to your risk level and use your preferred trailing method. Now, we talked about that. Risk to reward, the success of a trade can only be measured in terms of risk. Before initiating a good trade, you need to determine your fixed risk and your potential reward. But how are you going to do that? Super simple. The chart. By looking at the chart will determine your entry, your stop, your target, your risk, your reward. Okay? We looked at that support, resistance area, and projected targets. Also, these 3 simple chart elements will help you calculate risk and reward. What are those elements? Entry, stop, and target. Entry minus stop equals risk. Target is going to give you the reward levels. It is important to risk. It is important if the risk is too high for the reward, the trade should be canceled. Okay. Now, here's the example that I talked about. So basically, here's my entry, $25. Here's my stop, $24.25. 70 cents is my risk. My target one is at $27. That gives me $2 profit. That is 2.66 risk unit. Now, you could see here, I showed you this chart, how I got my projected target right into this prior high that was set. So everything is on the chart. So therefore, here's my projections for the core trade. Now, you tell me, can a trader that has a 40% batting average be better than a trader with a 60% batting average? Guys, I want to see some yes, type of 1 for yes, type of 2 for no, type of 3 for I'm not sure. Okay, you got it. Yes, by respecting, you guys are the best. I have to say, yes, absolutely. If you apply a good risk to reward, at least 3 to 1 risk to reward for each trade, you can and you will make money consistently. And for position sizing will determine, this goes hand in hand with the risk. Remember, position sizing will determine how many shares you're going to trade with based on your account size, your daily loss limit. Position sizing will also determine your risk to reward ratio. Here's an example. If you risk $200 on a trade, and if you have a 50-cent stop, you're going to be trading 400 shares for that specific trade. So therefore, the one position sizing rule that will bring green to your account is using the same risk on all trades. Also, same risk equals same losses equal consistent control losses, and winners are the only variable of this equation. Okay, before I wrap up and start answering some of your questions, I want to share with you a class that I will be hosting this Saturday. So this is Advanced Technical Analysis Skills. It's an online class. It is with me. It is live Saturday, August 16th. It is from 9:30 a.m. to 2:30 p.m. and usually we hold this class till like 3:30 or 4 o'clock because we do have tons of questions, and I do have a lot of applications on charts, and we do require a little bit more time. It is a class for equities, ETFs, futures, and Forex at the same time. And the class is for day traders, swing traders, and position traders. Everybody that attends will be getting the manual and recording for the class. And I will be teaching natural price support resistance. I will be teaching trend line support resistance and how you can initiate trades off these various levels. Intraday support resistance, and for those of you here that have been trading for a longer period of time, know that there are a lot of algorithms out there, gray boxes, black boxes, that are programmed to trade with these pivot points, and it is important to incorporate them into our trading strategies. Fulcrums, psychological price areas, and also I'm going to teach you how to work, how to apply with Fibonacci price extensions and retracements and projections. Remember, for stocks, ETFs that are all-time highs, you will know exactly where they're going to be traveling to, and they're going to bring you more confidence to the trading game. I'm going to talk about moving averages, what moving averages I use, and strategies that are based on moving averages. And of course, a lot of applications. I'm going to show you exactly what I do. And if you are using Fibonacci extensions or projections, you probably are using this kind of like the wrong ratios for projections at least. And I will be giving you my personal numbers and my personal setup for that. I will also share with you because I trade with TradeStation, I trade with Thinkorswim, and for those of you that are Thinkorswim traders, I will be sharing my entire platform with you. I will be sending you a link so you can automatically download it to your computer in case you like to use and to see how I have, you know, all my charts configured. You saw a glimpse of my charts and how they look. So if you do like that, I'll gladly share it with you guys. So we only have 100 spots available. They're usually going super, super fast. It is the last time we're doing it at this price. It's $49.99. It's $49.99. The original price is going to go back up to $499. We're not going to do this price. This is for TradingPub and for you guys that are here only. So only for you guys that are here. So nothing else. Take advantage if you think that this is something that you would like to learn. I'm more than happy to spend some time with you on Saturday for this incredible price. I think $49.99. Okay, so thank you so much, guys, for having me here today. If you should have any questions that we really don't have enough time, yes, it will be recorded. It will be fully recorded. I will also send you the manual. Yes. Okay, and if you have any other questions, I know we didn't have time for questions tonight, but please make sure that you know, make sure that you you register and you send me, if your question wasn't answered today, shoot an email to info@tradeoutloud.com. I do have a question. Pound dollar is consolidating right now. Looks like it has hit major support after a big drop. Your thoughts, bullish or bearish? I am actually bearish, but let's put the pound dollar real quick. Last seconds, guys. Okay. Okay, this is the 1 hour. This is the tight consolidation right here is 66.77. I'm looking at the 66.80 area because it's a fulcrum area. Right here, if it's going to break above, if it's going to break above the whole number, 6700, look for a follow through higher. For those of you that are Forex traders, into 6730, 6725. If not, if you're going to trade with the trend in this one, 6677, break down here. We're going to revisit the prior low. Also, the danger that is here is that we might expect a little bit of a bounce because we are bouncing off a prior support area, and we have the 200 period moving average right here. Oh my God, I have 42 seconds. Okay, so I'm sorry we can't squeeze in any questions, but please register, tradeoutloud.com. Only 100 spots left for this class. It's going to be the last class of the summer at this price. It's going to go back up $4.99 for the rest of the year. So take advantage. So thank you so much, guys. Thank you, TradingPub. Thank you, Yana, Rolly, and Cam. Thank you so much, guys. Thank you for all of you that took time off this beautiful summer night for spending it here with me. Thank you, and hope to see you again at another TradingPub event.